Tomorrow morning, something will happen in the silver market that could affect every single person watching this video. If you own silver, physical coins, bars, and ETF, mining stocks, what I'm about to show you matters. And if you don't own silver yet, this might be the video that changes your mind. Tomorrow is February 27th, 2026. It's a Friday. And it's COMEX March 1st Notice Day, the single most important date in the silver market this entire year. First Notice Day is when the clock starts ticking. It's the day when sellers on the exchange are legally permitted to announce their intent to deliver physical silver. And it's the day when buyers must have the full cash amount funded in their accounts. It marks the beginning of the physical settlement process for the largest silver futures contract of 2026. And right now, the numbers behind this delivery month are unlike anything the exchange has ever faced. Let me walk you through them. March 2026. Open interest currently sits at approximately 37,162 contracts. Each contract represents 5,000 troy ounces of silver. That means the total contractual claim on silver for March delivery is roughly 186 million ounces. Now, how much silver is actually available for delivery? COMEX registered silver sits at approximately 89 million ounces, and that number has been dropping every single day. Back in October 2025, registered silver was at 167.7 million ounces. It's now lost nearly half its inventory in less than 5 months. So we have 186 million ounces of contractual demand, pointing at 89 million ounces of deliverable supply. That's a 2-to-1 mismatch. In a normal year, that wouldn't matter. Most contracts roll forward. Maybe 5 to 10% stand for delivery. The system works. But 2026 is not a normal year. In February, which is a minor delivery month, not even close to March in size, the delivery rate hit 98%. Nearly every single contract demanded physical silver. January delivered 49.4 million ounces, more than 7 times the January 2024 level. The pattern is clear. Market participants are no longer rolling contracts forward. They want the metal, real physical silver. And that creates a problem, because if March sees even a fraction of February's delivery intensity, COMEX doesn't have enough registered silver to cover it. Not even close. So what happens? Does the exchange just fail? Does it default? Does silver go to $500 overnight? No, that's not how this works. And understanding what actually happens is far more important and far more disturbing than a simple default. Because the mechanism the banks will use to survive tomorrow involves something that directly affects millions of retail investors who think their silver is safe. And that mechanism has a name. It's called the SLV raid. Let me explain. The iShares Silver Trust, ticker SLV, is the world's largest silver ETF. It's managed by BlackRock. And its physical silver is stored in vaults operated by one company, JPMorgan Chase. Yes, the same JPMorgan Chase that is the largest trader of silver futures on COMEX. The same JPMorgan that paid a record $920 million fine in 2020 for manipulating precious metals futures markets. The same JPMorgan that in January 2026 issued 99% of all COMEX silver delivery notices through its house account. JPMorgan is simultaneously the custodian of SLV's physical silver and the dominant player in the futures market, where that silver might be needed to prevent a delivery failure. If that sounds like a conflict of interest, that's because it is the most egregious conflict of interest in modern commodity markets. Here's how the mechanism works. Pay close attention. Right now, JPMorgan's New York vault holds approximately 91 million ounces of silver that officially belongs to the SLV Trust. And technically, they do. The silver is there, the bars are real, the serial numbers are recorded. But here's what SLV holders don't realize. JPMorgan is what's called an authorized participant for SLV. That means JPMorgan has the legal right to redeem SLV shares in exchange for the underlying physical silver. And when they do this, the physical silver legally transfers from the ETF to JPMorgan's own possession. The process works like this. Step 1. JPMorgan buys or utilizes large blocks of SLV shares. Step 2. JPMorgan surrenders those shares back to the trust. In exchange, JPMorgan extracts the equivalent physical silver from the SLV vault. Step 3. The moment JPMorgan owns those bars outright, they attach COMEX delivery warrants to them. Instantly, those bars shift from the eligible category to the registered category on COMEX. They become deliverable. In plain English, JPMorgan takes silver that belongs to retail ETF investors, converts it into their own property, and uses it to restock the COMEX vault, so they can fulfill delivery obligations to institutional buyers who demanded physical metal. They're draining the retail piggy bank to bail out the wholesale exchange. Is this illegal? Technically, no. The SLV prospectus allows authorized participants to redeem shares for metal. It's a feature, not a bug from their perspective. But from the perspective of the millions of retail investors who bought SLV, thinking they had secure exposure to physical silver, it means your silver can be pulled out from under you to save a bank's trading position. And this isn't speculation. We have the historical pattern. In December 2025, when COMEX faced a delivery crunch, JPMorgan shifted 13.4 million ounces from registered to eligible, effectively locking their own silver away and declaring it not for sale. At the same time, they paid approximately $65 million in cash premiums through something called exchange for physical, or EFP, deals. These are essentially bribes. JPMorgan pays contract holders a premium above spot price to convince them to drop their COMEX delivery demand and accept settlement in London instead. The silver never has to leave New York, $65 million in a single transaction, to avoid delivering silver they supposedly had. That was December, a relatively minor month. Now we're heading into March, the biggest delivery month of the year, with the lowest registered inventory in years and the highest delivery intensity in COMEX history. The Against All Odds research team published their analysis 2 days ago. Their most likely scenario? JPMorgan will raid the 91 million ounces in SLV to cover March deliveries. Simultaneously, they'll deploy massive EFP bribes to roll contracts to London. And if that's not enough, the exchange itself may step in with emergency rules, including position close-only orders that ban new buying. This is not a conspiracy theory. Every mechanism I just described is documented in CME rules, SLV's prospectus, and CFTC filings. The question isn't whether they can do this, it's whether it will be enough this time. Let me lay out the complete playbook of what the banks and the exchange will do over the next 30 days to survive March. Because this isn't a one-day event. First notice day is just the starting gun. The actual delivery process stretches across the entire month. Trick number 1, the SLV raid I just described. JPMorgan redeems SLV shares, extracts physical bars, warrants them for COMEX delivery. Estimated available, 91 million ounces. This alone could theoretically double the registered inventory overnight on paper. But every ounce they take from SLV is an ounce that no longer backs the ETF shares held by retail investors. Trick number 2, exchange for physical deals. EFP is a mechanism where COMEX contract holders agree to swap their New York delivery for a London position, meaning they accept a promise of metal in London instead of actual delivery in New York. To make this attractive, JPMorgan pays significant cash premiums. In December, that premium was reportedly several dollars per ounce. At current prices of $87, even a $3 premium on millions of ounces adds up to tens of millions of dollars. It's expensive, but it's cheaper than admitting you don't have the silver. Trick number 3, margin hikes. The CME can raise margin requirements at any time, with as little as 1 day's notice. Higher margins mean traders need more cash in their accounts to hold contracts. This forces smaller players, retail traders, small funds, to sell their positions. It's a targeted weapon against the long side of the market. In 2011, during silver's run to $49, CME raised margins 5 times in 8 trading days. In the January 2026 volatility, they hiked margins twice in 48 hours over a holiday weekend when nobody was watching. Trick number 4, Silver Rule 7. This is the nuclear option. During the Hunt brothers squeeze in 1980, the COMEX board literally changed the rules mid-game. They implemented liquidation-only trading, meaning you could only sell silver futures, not buy them. All buy orders were banned. The price collapsed from $50 to $10. The rule still exists in the CME's emergency powers. If March gets ugly enough, they can invoke it again. Trick number 5, reclassification games. COMEX inventory has 2 categories. Registered means the silver has a warrant and is available for delivery. Eligible means the silver is in the vault but not available for delivery, and the owner hasn't offered it. Banks can shift metal between these categories at will. In December, JPMorgan moved 13.4 million ounces from registered to eligible. That made the registered number look lower. Why would they do that? Because it removed their own silver from the deliverable pool, forcing the squeeze pressure onto other vault operators, while JPMorgan watched from the sidelines. Trick number 6, cash settlement at premium. If all else fails, the exchange can offer longs a cash settlement above the futures price. Instead of delivering silver, they pay you the money plus a premium. Many contract holders will accept this. Cash is cash. But every cash settlement is an admission that the physical silver doesn't exist in sufficient quantity, and that admission erodes confidence in the entire paper pricing system. Here's what most people miss. All 6 of these tricks have been used before. All 6 of them work, temporarily. But each time they're used, the system loses credibility. Each margin hike tells traders the exchange is afraid. Each EFP deal tells the market that New York can't deliver. Each SLV raid tells retail investors that their ETF is a slush fund for bullion banks. And here's the critical thing. Every trick that deflects delivery demand in March simply pushes it forward to May, and May pushes to July, and July pushes to September. The demand doesn't disappear, it compounds, because the buyers who wanted physical silver in March will come back in May even more aggressively, with more capital and more distrust. This is a ratchet, it only tightens. So who wins and who loses in this game? Let me break it down clearly because this affects different types of silver investors very differently. If you own SLV, the iShares Silver Trust ETF, you are in the most vulnerable position. Your silver sits in JPMorgan's vault. JPMorgan has the legal right to redeem those shares and extract the physical metal. If they raid SLV to cover COMEX deliveries, the trust's physical backing decreases. The shares still exist, but the silver behind them shrinks. In a worst-case scenario, SLV could even be forced to suspend redemptions, meaning you can't get your money out. This happened with multiple commodity ETFs in the past when physical backing became uncertain. Now, to be clear, SLV will not go to zero. The trust has rules and mechanisms, but the key point is that SLV gives you price exposure without guaranteed physical backing. You own a share of a trust whose metal can legally be borrowed against, rehypothecated, or redeemed by authorized participants. If you bought SLV thinking you owned physical silver, you need to reconsider that assumption. If you own PSLV, the Sprott Physical Silver Trust, you're in a very different position. PSLV stores its silver in the Royal Canadian Mint, a sovereign government facility. JPMorgan has zero access to it. No authorized participant can redeem it without Sprott's consent, and Sprott just doubled its at-the-market program to $2 billion, specifically to buy more physical silver. At current prices, that's approximately 18 million ounces of additional buying power. Sprott is actively competing with COMEX for physical metal, and they're doing it with allocated, segregated storage that no bank can touch. If you own physical silver, coins, bars, rounds in your own possession, you are the most protected investor in this entire scenario. Your silver is yours. No bank can redeem it. No exchange can reclassify it. No authorized participant can extract it from your safe. The entire COMEX drama is irrelevant to your holdings. The only thing that changes for you is the price. And if the delivery crisis intensifies, that price goes up significantly. Now, who else benefits? China. China has been systematically positioning for this exact scenario. They restricted silver exports in November 2025, reclassifying silver as a strategic resource requiring government licenses. Only 44 companies received authorization to export silver. Beijing effectively put a chokehold on 60 to 70% of globally traded refined silver. Meanwhile, Chinese buyers, both industrial and financial, are accumulating silver at premiums of $5 to $8 above Western prices. The Shanghai Futures Exchange consistently prices silver above COMEX. This premium is the market's way of saying, we will pay whatever it takes to secure physical metal regardless of what the paper market says. JPMorgan itself appears to recognize where the future of silver pricing lies. Reports indicate they've shifted or concentrated their precious metals trading desk to Singapore, closer to Asian physical markets, further from the COMEX paper system they helped build. When the dominant player in the paper market quietly repositions toward the physical market, that tells you everything about which system they think will win and who loses. Bullion banks with large short positions and insufficient physical backing. Smaller banks that followed JPMorgan's old playbook of shorting COMEX futures are now trapped. They're short at $65 to $75, while physical silver trades at $87 and rising. They can't cover because there isn't enough metal available at any price. The December $65 million EFP bailout gave them 3 months of breathing room. That room expires this week. If the March delivery cycle generates enough pressure, we could see smaller bullion dealers announce temporary suspensions or restructuring. Not JPMorgan. They've already flipped net long and positioned themselves to profit from the very crisis they helped create. But the smaller players who held the short side, they're the ones swimming naked when the tide goes out. Let me put all the numbers together and tell you exactly what I'm watching over the next 30 days. Because this is not a guessing game. Every number I'm about to give you comes from CME reports, ETF filings, and CFTC data. The math. March open interest, 186 million ounces across 37,000 contracts. COMEX registered silver, 89 million ounces. SLV Vault, silver in JPMorgan's custody, 91 million ounces. Combined theoretical maximum deliverable, 180 million ounces if JPMorgan raids all of SLV. But even rating all of SLV barely covers March demand if the delivery rate stays above 50%. The timeline. Tomorrow, February 27th, first notice day. This is when we first see how many contracts stand for delivery versus how many rolled. The initial report drops on February 28th. If standing contracts exceed 40% of open interest, that's 74 million ounces, this will be the most intense March delivery in COMEX history. If they exceed 60%, 112 million ounces. We're in full crisis mode. March 1st through 7th, the first week of actual deliveries. Watch the daily delivery reports for how many ounces are issued and stopped. Watch whether JPMorgan appears on the issuing side. That means they're delivering silver from their vaults. Watch whether SLV reports changes in total ounces held. That's the canary in the coal mine for the ETF raid. March 8th through 14th, mid-month checkpoint. By this point, we'll know whether the SLV raid is happening. Check SLV's daily bar list. It's published on BlackRock's website. If bars are disappearing from the New York vault and simultaneously appearing as COMEX registered inventory, the raid is confirmed. March 15th through 31st, the endgame. Any remaining open contracts must be settled. If physical delivery demand exceeds available supply even after the SLV raid and EFP bribes, we could see emergency measures, margin hikes, position limits, possibly even trading halts. And if March fails to satisfy demand, the pressure rolls directly into May, which could be even more explosive because May will include everyone who got denied in March. Now, here's what I'm watching specifically. Signal 1, SLV daily holdings reports. If the total ounces in SLV drop by more than 5 million ounces in a single week, the raid is underway. Track this on BlackRock's website. It's free and public. Signal 2, COMEX registered silver. If registered inventory increases during a delivery month, that's counterintuitive and it means metal is being moved in from somewhere. The most likely source? SLV. Signal 3, EFP volumes. The CME publishes exchange for physical transaction data. If EFP volumes spike above normal levels, it means banks are paying premiums to avoid New York delivery. That's desperation disguised as market mechanics. Signal 4, Shanghai premium. Currently $3 to $5 above COMEX. If it widens to $8 or $10, that means Asian buyers are so desperate for metal that they'll pay any premium. That widens the incentive for Western metal to flow east, further draining COMEX. Signal 5, margin changes. If CME raises silver margins during March delivery, that's the exchange intervening to shake out long positions. Time it with gold price action. If gold stays flat but silver margins spike, it's targeted suppression. I want to leave you with this thought. JPMorgan paid $920 million in fines for silver manipulation. They were caught spoofing the market with fake orders. They admitted to it. And then they were allowed to continue operating as the dominant force in the silver market and the custodian of the world's largest silver ETF. Think about what that means. The entity that was convicted of manipulating silver prices is the same entity that holds your silver in SLV and has the legal power to extract it whenever they need to cover their positions. Tomorrow, the delivery process begins. The silver in those vaults, your silver if you hold SLV, becomes a pawn in a game between banks fighting for survival and buyers demanding real metal. If you found this video valuable, subscribe and turn on notifications. I'll be covering the March delivery data daily, every report, every vault change, every signal. Check the description for the full breakdown of what to watch and when. This is Money and Empires, your silver, their game. Know the rules.